Hello class, and here is chapter 14, all about money, the Federal Reserve, and interest rates. We're going to go through the functions of money, what makes up the money supply, what backs it, our Federal Reserve and the banking system of our country, the functions of the Federal Reserve, fractional reserve banking and our money supply, and finally interest rates. So for something to be money in an economic sense, it has to have a few characteristics. First off, it has to be a medium of exchange, meaning wherever the money was issued, it can be used to buy and sell goods. For something to be functional money, everywhere in its economy, it has to be accepted. So something like Bitcoin has tremendous value, but it does not meet the definition of money because not everybody is going to accept it for the purchase of goods, or if someone chooses to sell their goods, would take it. Money is a unit of account. In the United States, we value goods in dollars. Other countries use euros, yen, won, but whatever your money is, we use it as a way to value things. Instead of being subjective by assigning prices in dollars, it allows us to make quick comparisons. And finally, money is a store of value. You can hold some of your wealth in money. You don't just have to own physical things. I can have cash, I can have money in my checking accounts, investment accounts, and it also is liquid. Liquid means it can be easily changed into something else. If I take out a $100 bill, I can easily use it to purchase something, whereas if I have a gold coin or a silver bar, it might have tremendous value, but if no one wants to accept it, I'm going to have to convert it into something else before I can take advantage of that value. So money meets multiple definitions in an economy, and M1 is liquid money. M1 is currency, so physical cash, checking accounts, and other very liquid deposits, meaning bank accounts that you can easily access. Institutions that offer checking accounts, commercial banks, your Chase, your TD, your Capital One, thrift institutions such as credit unions like Four Leaf or Jovia, mutual savings banks, savings and loan institutions. Checking accounts are by definition treated in an economic sense the same as cash. You can instantly use them to pay for things. So currency consists of coins and paper money. Think of the cash and change that we use. And the money issued are known as Federal Reserve notes. Those are the dollar bills that we spend. Now, the value of any piece of currency is unrelated to its intrinsic value. And what that means is in the past, money was backed by things. So old money many years ago was backed by silver and gold. In addition to, the government used to issue silver and gold coins that had intrinsic value. A silver dollar was worth $1 by default. That's what was written on it. But it was worth also what it weighed in silver. And now a silver dollar, if you have an old one, is worth significantly more than $1. So the money that we spend today is not related to its intrinsic value. It is issued by the government, and the government states that's what it's worth. M2 is what is known as near money. So it's all of M1 plus anything known as near money. Small denominated time deposits. You might have taken out one day what's called a CD, or a certificate of deposit. That's when you give your bank money denominated in $1,000 increments, and they promise to pay you a rate of return after a certain amount of time. That would be part of M2. Other types of accounts that you may only be able to withdraw a certain amount per time or face penalties to pull money out, that's M2 as well. Things like savings accounts, money markets, and things like that. So M2 is what's called near money. It's less liquid than M1, but it's still more liquid than physical assets. If you have a bunch of money in a checking account, you may have to pay a penalty or wait a few days to get the money out, but it's generally easier to get that money than if you own some sort of a valuable asset like a painting and have to go through the process of selling it. Even though it might be worth tens to hundreds of thousands of dollars, you have to find someone to want to buy it to be able to get your money back. So here's the difference between M1 and M2. This is as of about, I believe, 2 years ago. It has since gone up. But currency, paper banknotes, about 2.1 trillion circulating. Checking accounts, 4.7 trillion. There's other liquid deposits. So M1 versus M2. M1 about 20.3 trillion. M2 about 21.4. So what backs money? All modern money issued by governments today, for the most part, is just simply backed by a government's ability to keep the value stable. And that's a very important point. It's what's known as fiat money, or what is basically the money which we utilize on a daily basis. The government promises that a dollar is worth a dollar, and it's backed by the full faith and credit of the United States government. What makes money valuable? Well, once again, it's acceptable throughout an economy. Everybody wants dollar bills in the U.S. because we can use them to buy whatever we want. It is by definition legal tender, meaning the government states that it is the money of the land by law. And relative scarcity. In theory, money is managed to a point where they don't print so much of it becomes worthless, although we have been printing significantly more money recently. And you can argue money is a form of debt because it is an obligation of the government to stand behind that money and back it. Prices affect the purchasing power of money. So we've heard over the last several years quite a bit about inflation. And what inflation means is the value of money is going down. Prices are going up, so the same $100 bill that last year may have bought you 2 bags of groceries may now only buy you 1. So if we have situations where inflation is going on, the purchasing power of our money is going down. So even though we may have the same amount of money, in reality we're worth less because we can do less with that money. Hyperinflation are situations where inflation gets so bad money basically becomes broken and useless. Most recently we saw this in Zimbabwe in about 2008. They literally printed a $100 trillion bill, which was worth about a quarter in our money. So in situations of hyperinflation, prices are going up so fast that money becomes worthless and useless, and the whole monetary system breaks down. So to make sure that money has stable purchasing power and it's not losing tremendous amounts of value in a short amount of time, we need to try to intelligently manage that money supply. And that's what's known as monetary policy. How much money is in an economy, whether we grow or shrink that supply, by definition that is known as monetary policy, and that's a very important term. Fiscal policy being appropriate as well. Fiscal policy is government spending. How much the government chooses to spend, that is known as fiscal policy. And making sure that the government's not going too greatly into debt is very important for a well-running economy. So the Central Bank of the United States is known as the Federal Reserve. It's governed by the aptly named Board of Governors, and each of the 12 Federal Reserve banks, which are spread throughout our country, have a central governor. And then there is the chairman of the Fed, currently Jerome Powell. The Fed serves as the central bank of the United States, and we would argue they're quasi-public, quasi-private. The reason being, the members of the Federal Reserve are appointed by the federal government, but once they are confirmed, they then serve their terms basically without government interference. And they are what are known as the bankers' banks. The Federal Reserve is not a bank you or I can go borrow money from or open an account. They serve the commercial banks. So Chase, Capital One, they can borrow money from the Federal Reserve. And they also store their reserve balances, meaning the money that they have from their depositors, they can store them at the Federal Reserve, get a rate of interest on them, and make sure that their money is safe. So the Federal Reserve deals with banks. You or I can't walk into a Federal Reserve bank and borrow money. So the Board of Governors controls the Fed. They have 12 Federal Reserve banks. The Open Market Committee sets interest rates. And the Federal Reserve banks serve commercial banks and things like savings and loans, mutual savings banks, and credit unions. And these banks here are the ones that you and I, the public, interact with. So we can't go to the Fed and borrow money or open a credit card from the New York Federal Reserve, but they keep the banking system running that we interact with. And here's the districts of the Federal Reserve spread throughout our country. Boston, New York, Philly, Richmond, Atlanta, Chicago, St. Louis, so on and so forth. We have 12 districts. The Open Market Committee helps the Board of Governors by setting monetary policy and also conducts open market operations. What that means is they buy and sell government bonds to either increase or decrease the money supply. If the Federal Reserve buys government bonds, the money they buy them with goes into the economy and it increases the money supply. If they sell the government bonds they're holding, the money that they get by selling them, they pull out of the money supply. So open market operations are one tool the Fed has for controlling the money supply. There are approximately 4,300 different commercial bank companies in the United States and about 7,000 or so thrifts, including things like credit unions. And here are just some of the largest banks in the world. The top 4 currently are in China, then Mitsubishi in Japan, HSBC in Britain, BNP Paribas in France, and the largest bank in the US currently is JP Morgan Chase, closely followed by Bank of America. And this is as of 2021. These numbers have since gone up a bit. So what can the Federal Reserve do? First off, it issues currency. The money in our pocket states that they are Federal Reserve notes. They hold bank reserves and set reserve requirements. In 2020, however, they ended reserve requirements during COVID. But reserve requirements are basically how much money a bank needs to hold of their deposits in reserve to make sure the bank is stable. A bank can't just simply take every dime it has and lend it out, because if they do that, you wouldn't be able to go to an ATM and get money. And when banks do have reserves, they generally hold them at the Fed for safety reasons, and also the Fed does pay interest on them. The Fed lends money to banks. If banks need to borrow money, they can borrow it from the Fed. They collect checks and process them. They act as a fiscal agent for the U.S. government when the U.S. government enters into monetary deals. They supervise banks, one of the largest powers of the Fed. They can audit banks, supervise them, order them to clean up their books or do things, or wind down a bank that is not stable. And they also control the money supply. Once again, they were established at the turn of the 20th century, chartered in 1913, started operating in 1914 as an independent agency, and in theory this does protect the Fed from political pressures. In practice, we've seen the president recently getting into spats with the chairman of the Fed, Mr. Powell. So are they totally immune from political pressure? No. However, once members of the Federal Reserve are appointed to their terms, they do not run for election, so they are independent in that sense. And this, in theory, enables the Fed to take actions to increase interest rates in order to stem inflation as needed. We saw this after the large inflation in 2021, where the Fed raised rates to try to reduce that inflation. And the banking system in modern economies is what's known as fractional reserves. In the early days of economics, economies ran on gold. And goldsmiths stored gold and gave a receipt. So if I had a big bag of gold and I did not feel like walking around with it for obvious reasons, you could lose it, you can get robbed, it's not exactly the most easy thing to transport. You could store your gold with goldsmiths, which were like early banks, and they would give you a paper receipt stating that I had 50 ounces of gold at this bank. I could use those receipts as money. So if I had a receipt for each ounce of gold, I could trade that receipt to someone, and he or she could then go to that bank and withdraw the gold. And they also made loans as well by issuing receipts. Now, you can understand why this led to paper money, because pretty shortly after, people realized it was much easier to carry paper money stating you had gold or some sort of asset instead of carrying the asset itself. And this led to modern banks. Banks create money through lending. If I put my money in a bank, I make deposits, that bank isn't going to just sit on them until I take them out. They're going to use them to make loans. Home mortgages, car loans, think of all the loans you can get from banks. But banks can be subject as a consequence to panics. Since they're loaning out a lot of the money they have, they're not keeping it all. If the economy gets shaky, or people lose trust in the bank and try to all pull their money out at the same time, the bank is probably not going to have all of that money to pay out. So the Federal Reserve has done a few things to reduce those panics. Number one, banks have to belong to what's known as the FDIC. It is an insurance policy that if your bank fails, the federal government will pay out each depositor up to $250,000. So as long as you have less than that in a bank, you will be made whole by the government if your bank goes out of business. The Fed also can do things such as alter the money supply by modulating incentives and restrictions it places on banks and thrifts. So what this means is They could put more restrictions on banks to reduce the money supply or less to increase it. If Fed policy prompts banks to increase lending, access to credit's easier, there's more money in the economy, and vice versa. If banks decrease lending, we have less loans, higher rates, and less money in the economy. Just like anything else in economics, the relationship with money and supply and demand is interest rates, the cost of money. If there's large demand for money, interest rates go up. If there's lower demand for money, interest rates go down. And interest, once again, is the price paid for the use of money. If I borrow money, the interest rate that I have to pay it back at, that's the price for that money. There are many different interest rates, but overall they are determined by money supply and money demand. And then all the rates we experience are functions of that main rate. So the demand for money, transaction demand for money, or DT, that's determined by our nominal GDP, and it's really independent of the interest rate. But the asset demand for money, where money is a store of value, that is directly correlated with prevailing interest rates. Whether or not people want it more or less, that's going to float the rates. And total demand for money is just simply the total demand for money. So just like anything else in economics, money has an equilibrium interest rate, and it changes with shifts in the money supply and money demand. So interest rates and bond prices are inversely related. This is a question I get often, but if you take out a bond, so I buy a bond, it could be a bond from New York City or from a company. A bond is a promise to pay back a loan we give to someone at a stated interest rate. So it could pay an annual payment, a quarterly payment. So let's say we buy a simple bond, we buy a $1,000 face value bond that pays 6% interest. If the interest rates in our economy go up and now are 8%, we could get 8% putting our money elsewhere. So that bond is not a very attractive investment. It's paying less interest than the prevailing rate. So as a consequence, that bond price is going to drop. Bonds are denominated in a face value. It's usually $1,000, but I might be able to get that bond for $900 to make up the difference because it is at a lower interest rate than overall in the economy. If the bond is paying a higher interest rate than the interest rates in the economy, that bond is going to sell at a premium. We're going to have to spend more than the face value of that bond to make up the difference. So prices of bonds are constantly changing depending on the prevailing interest rate in the economy. Cryptocurrencies, so Bitcoin, Ethereum, and there are tons more of them. Once again, cryptocurrencies are not money per se because they don't meet the criteria of money. They're not a stable store of value because they constantly are changing value very quickly. They are not acceptable throughout an economy, but they are assets of great value. Cryptocurrencies, as we know, utilize blockchain technology. It tracks the ownership of digital money. It makes it very hard to hack or compromise. And some economists have been arguing that a lot of central banks, the Fed and other things, may one day issue their own digital currencies to try to eclipse things like Bitcoin. Whether or not that happens entirely remains to be seen. So that's going to take us to the end of chapter 14.